Hey, good afternoon. I'm Randy Price. My partner's name is Matt Price, and collectively we are the Price Group. Welcome to our October monthly update. Session will last about 15 minutes or so. We thank you for joining us. There'll be time for questions at the end. And our goal with this is to provide some actionable information, some perspective on what's going on, and help you stay better connected to the crazy world that we continue to see and to live in. So who are we? We are a family-owned and operated boutique, 40 plus years of experience. We follow a fiduciary standard, and those of you who are clients know that we are a retirement group. Over 80% of our clients are retired or close to being retired, and so that's where we feel most comfortable giving advice and providing insight. And so with that, again, we welcome you, and we'll get right into it.
And for clients, this will be a brief overview. Randy's been nominated by Barron's, Forbes, Financial Times. We're both CFPs, Certified Financial Planners. We both went to Wharton to get our CIMA, our Certified Investment Management Analyst designation. That's kind of a mouthful. Our firm, Steward Partners, based off the biblical definition of stewardship. Raymond James is one of our two custodial options. Custodial options meaning where client assets are held. Pershing is the other one, but Raymond James has been a great partner, and currently all clients are using Raymond James. So let's jump into 5, 6, maybe even 7 slides on what's going on.
Headwinds for the economy, and if you've been paying attention with interest rates, that is indeed what is going on. Interest rates have moved higher. The Federal Reserve has said the economy is growing too fast, and we're going to slow it down. And it sort of reminds me of that treadmill test. If you've ever taken one of those, the machine always wins, and so the Federal Reserve keeps raising rates, trying to get the economy to be in a more level state, lower inflation, but a slower labor market. We've seen some of the tech companies be in the news even as of today, shedding some jobs, combined with tighter lending standards by the banks will indeed weigh on the economy. Job growth is set to turn negative. The slide on the left, 90-day credit card delinquencies are higher. And again, banks are tightening lending standards. We just talked to a gentleman this morning, and he said, the bank had said, nah, we don't want to do that business anymore. And so the banks are trying to improve the credit quality of their portfolio as well. So recession, is it going to happen? Well, recession, again, let's look at that. A recession is 2 straight quarters, 3-month periods where the economy shrinks. The gross domestic product is negative. A recession can be mild, it can be medium, or it can be a big recession, deep recession. Despite some of the increased calls for a soft landing, I'd call that where you really don't know that the economy has grown or shrunk, sort of benign time period. We continue to forecast a mild recession to begin in the first quarter of 2024. There on the left of the screen, the economic growth typically is strong leading into the recession. And again, the recession is expected to start in the first quarter. First quarter 24, the prediction is a shrinkage of 0.8%, which is not a lot. And in the second quarter, 1.2. So again, a mild recession. We sometimes remember the recessions that are more than mild and deep, and again, where the economy would shrink much more than that.
So as far as inflation, this is a question I'd say we get, if not the most, it's definitely a top 3 question from clients. We think that inflation continues to move lower for a few reasons, but number one, the price of goods, you see there on the right, have continued to move lower. We don't think this is a seasonal thing that we can see from time to time, depending on what month of the year it is. We think this is here to stay. We look here on the next slide, shelter prices are also moving lower. So this is typically a what we call a lagging indicator. So typically coming after the fact, after inflation moves lower. So this kind of follows the lower inflation numbers and actually typically helps drive them higher, or in this case, we think lower moving forward. And then maybe a little bit busy, but the chart there on the right, some of the hotter months of inflation. Remember, the consumer price index, or the CPI that you hear talked about or you read about, is a look at the average increase of prices over the last 12-month period. So every month you have, in this case, it being October, you have the October from the previous year fall off. As you can see, we do have some higher figures that will be following off over the next 1, 2, 3, 4, 5 months, which just by definition will help reduce the overall inflation figure that is posted.
So we have election season starting here in Houston with some city elections, but this is sort of a look back on what's happened in the government with the president, Speaker of the House, and the Senate for the various years forecast there. Obviously, 2024 will be an election year, and that sort of starts now with some of the races around the country, but primaries in the spring, and then the general election to be held in fall of 2024. So a lot of folks are very well aware that inflation is higher, prices up at the grocery store, and if you've been shopping for mortgages, etc., you know that the mortgage rates, which were in the 2 and 3%, almost giving away money, if you will, now are in the 7 to 8% range. But so interest rates up, bond prices are down, so that's put pressure on the price of any fixed income, any CD, any tax-free bond, any corporate bond that you owned and own. And the thing that has been amazing is been the relativeness of that, and that for many, many years, interest rates just stayed low, went down, stayed low, went down. And now for the first time, interest rates are coming back up again, caused by inflation, printing too much money, money supply, this sort of thing. The year-end 10-year target, some people did a poor job on forecasting, unless interest rates start to move lower. Currently, the 10-year Treasury is about 4.8%. But anyway, the duration of the drawdown there shown on the right, 2 times longer than the next longest drawdown. So the big question that everybody asks is, where will interest rates stop? And typically, once the Federal Reserve stops their raising of their short-term interest rates, typically 6 to 9 months later, long-term interest rates are lower. But again, stay tuned. We will continue to monitor that.
And so let's look at exactly why we say that. Let's look at the chart here on the left first. The yields decline following a recession. And you can see that dotted blue line, on average, it's a reduction by 1 to 1.5%. So that's where we get this number of that 3.5. It, like Randy said, it's probably not by the end of this calendar year, but that would be our anticipated 10-year U.S. government bond interest rate, maybe 6, 9, 12 months from now. From a standpoint, just historically speaking, that's what's happened on average. As you can see, there's been periods where rates have moved lower than that. There's been periods where rates did not move as much, but that is the average if you look back over the last 5 drawdowns of rates after the Federal Reserve does pause their interest rate increases. The middle chart there, interest rates typically do follow inflation, and inflation has not fully rolled over, but it's in the process of continuing to roll over, is what we think. And interest rates typically lag on that front. So overall, we do think interest rates move lower in the next year. If you know exactly when they're going to move lower or not, please let us know. We'd like to hire you. But all kidding aside, this is a thing that we do spend a lot of time talking about internally with clients as well. We're actually going to be pushing out later this week a more detailed overview of our thoughts within the fixed income market, kind of what changes have we made this year, what are we thinking on changes moving forward.
And man, I guess that's the maybe the bottom line is don't give up on fixed income. And at some point, cash is not an investment. Cash is a convenient parking lot for funds that you're not using. We've had great success with using an institutional money market that's got a yield of over 5% on some of the cash, but at some point, as you say, Matt, extending the maturities, maybe locking in some more CDs or tax-free bonds, corporate bonds, etc., could be very helpful to long-term returns.
Yeah, totally agree. And then our last slide here before we wrap it up. What are our thoughts overall on the stock market? This chart here on the right, I think, is not necessarily intuitive, but I think very helpful to the long-term investor. And what I want to draw your attention to here is kind of where the stock market historically, on average, bottoms. And it's approximately 100 days before the end of a recession. So a lot of folks will say, well, you know what, there's a lot of craziness out there in the world. I'm going to just wait until everything, quote unquote, settles down. And what you can see once the recession ends, you've already made once again, on average, a really big move here. While the recession is still going on, stocks start to move higher. So we think we're still, it's going to be choppy. We're not of the opinion that stocks go straight up from here. Mr. Buffett, he has a famous saying. He says, neither I nor you are smart enough to predict where stock prices will be within a year from now. And we hold tightly to that. But over the long term, we do think with interest rates potentially moving lower, with a mild forecast, like Randy said, not a moderate or an aggressive recession, and still having cash on the sidelines, we're of the opinion long-term stocks should climb the proverbial wall of worry, and we think that's a good thing long-term.
And then one more thing, Matt, obviously, we think one of our secret sauces is the use of dividend stocks. So we're getting income from our stocks, and if we're doing our job correctly, we're getting dividend increases as well. Long-term, the dividend stocks have been healthier companies. Stock companies raising their dividend have been the healthier companies with an increased sort of inflation, go against the inflation to give you some higher income as well. So even in 2009, we saw the portfolio paying higher dividends following the Great Recession of 2008. So again, we remain optimistic, but a lot of stuff going on in the world right now. So that concludes our remarks. Appreciate each of you being here, taking time. As always, please feel to reach out, questions or comments. That's Tiffany, Matt, myself, Maddie Kearns, and Melissa. Email, phone numbers right there. We again are here. No such thing as a bad question. And again, we hope that these monthly communications will help you with perspective and address some of your concerns. Matt,
no questions. Yeah, no questions now. But shoot us an email, give us a call if you have any. By the way, we always record these, and we'll send out a recording for any spouses or friends that you might want to pass this along to.
Okay, so he's Matt Price. I'm Matt Price. Collectively, we are the Price Group. And again, here for you. Have a great rest of the afternoon, and hope to talk soon. Thanks so much.